Imagine owning a monopoly where it is literally legally impossible for anyone else to build a competing factory. Like, nobody can touch you.
Right. The ultimate moat.
Yeah, exactly. And you have zero debt. Your flagship products are basically immune to inflation, and you're just sitting on this mountain of cash.
You'd buy that instantly. I mean, anyone would.
Of course. But now imagine that exact same stock is suddenly trading at a massive, like, 48% discount to its intrinsic mathematical value.
Which is wild.
It is. That's the kind of setup that makes value investors absolutely salivate. But it's also the kind of setup that should make you deeply, deeply paranoid.
Oh, absolutely. It sets off all the alarm bells.
Right.
Because in financial markets, fear is highly contagious. Investors aren't really looking at Carlsberg's pristine balance sheet today. They're looking at the burning wreckage of the guy living next door.
The neighbor's house is on fire.
Exactly. And they're assuming that fire's just going to spread right over the fence.
Welcome back to the Night Eyes 08 channel, everyone, and thank you for joining us for another deep dive.
Glad to be here. We've got a lot to unpack today.
We really do. So if you've been following the channel, you already know about that burning wreckage we just mentioned.
Yeah, we covered it pretty extensively.
We did. In our previous deep dive, which was titled Heineken Malaysia Plunges 10%, Market Overreaction or Time to Sell, we dissected the absolute disaster that was Heineken's second quarter earnings.
Right. We looked at how their revenue just fell off a cliff.
Yeah.
Their profits basically evaporated, and the market punished them severely. I mean, the stock plummeted 10.5% down to 17 ringgit almost overnight.
Just a brutal, brutal drop.
It was. It was a structural re-rating of their entire business model, mainly based on this severe inventory chokehold.
Right. And the response to that analysis from you guys was incredible. But there was this one specific viewer comment that, well, it really changed our trajectory.
Yeah, it sparked this entire deep dive, honestly.
Exactly. They essentially laid out this brilliant logical trap. They asked, if Heineken is bleeding out on the operating table, what does that mean for its only real rival?
Right.
What is the actual diagnosis for Carlsberg Brewery Malaysia?
And for those checking their terminals, that's ticker code CRRLSBG or 2836.
Thanks for adding that. And it's just a mandatory follow-up question, right? Like, you cannot analyze one half of a duopoly in a vacuum.
No, you really can't. Because on August 6th, 2026, when Heineken released those terrible Q2 results, the market didn't just isolate the punishment.
Right. They dragged everything down.
Exactly. In what we call a classic sympathy sell-off, institutional algorithms and, panicked retail investors dragged Carlsberg right down with it.
Yeah, Carlsberg dropped roughly 10% as well. It fell from trading steadily over 16 ringgit and 20 sen down to 14 ringgit and 46 sen as of August 14th.
Which is a massive haircut for a supposedly stable company.
It is. Which brings us to the core thesis we need to explore for you today. We really have to separate the signal from the noise here.
Right.
Is this a completely unfair sympathy drag? Like, is the market just blindly pulling down a perfectly healthy cash-printing machine just because its neighbor's house caught fire?
Or are there shared structural industry headwinds creeping through the foundation that absolutely justify applying this deep discount to Carlsberg as well?
Exactly. And to figure that out, we have to stress test the foundation.
We really do. Before we even touch the Q2 2026 earnings that caused all this recent chaos, we need to completely deconstruct the structural power of Carlsberg's business model.
Because if you don't understand the physical and legal moat surrounding this company...
The valuation math we're going to do later just won't make any sense at all.
Yeah, let's talk about that moat. When we analyze companies, we usually look for, competitive advantages.
Right, like a great brand or a cheap supply chain.
Or maybe some patented technology.
Yeah.
But Carlsberg's moat in Malaysia isn't just an advantage, it's an iron wall.
It really is. In our financial moat scorecard, we actually give their market structure and duopoly advantage a 9.5 out of 10.
Wow. 9.5.
Yeah, you almost never see a score that high in the consumer goods sector. We're talking about an impenetrable regulatory moat.
Right.
The Malaysian malt liquor industry is a highly rational, government-enforced duopoly shared almost exclusively between Carlsberg Malaysia and Heineken Malaysia.
I really want to pause here and just emphasize the mechanics of this for the listener, because it's not like the tech sector where a couple of kids in a garage can disrupt the whole industry, right?
No, not at all.
It's literally like playing a two-player game of Monopoly where the government has just permanently thrown away the dice for anyone else wanting to join the board.
That is a perfect analogy.
The government simply does not issue new commercial brewing licenses, period.
Right. The barrier to entry isn't financial, it is legally insurmountable. I mean, you could have $1 billion in liquid capital ready to deploy tomorrow. You could have the greatest beer recipe on earth, a perfect marketing plan, a pre-built distribution network. It doesn't matter.
None of it matters.
Exactly. You physically cannot build a massive commercial brewery in Malaysia to compete with them.
So the core domestic market is essentially a locked fortress.
It is.
But here is where Carlsberg diverges wildly from Heineken. Carlsberg isn't just sitting behind this one Malaysian wall, hoping the local economy stays strong.
Right. Their corporate structure is actually built on 3 distinct pillars.
Which creates a really fascinating geographic hedge. So, Pillar 1, the Shah Alam Brewery in Selangor. That's the heart of the operation, absolutely.
Oh, definitely. And from a historical perspective, that facility is legendary. It was actually the very first brewery Carlsberg ever built outside of Copenhagen, Denmark, way back in 1972.
Oh, wow, really? 1972?
Yeah, it's a massive, highly optimized facility. But the second pillar is their 100% ownership of Carlsberg Singapore.
Okay, controlling the Singapore market makes geographical sense. I mean, they're right next door.
Right.
But it's the third pillar that I think is really going to trip people up.
Yeah.
If you pull up their annual report, you see this highly lucrative 25% equity stake in Lion Brewery Ceylon PLC.
Located in Sri Lanka.
Yeah, Sri Lanka. If this company is officially Carlsberg Brewery Malaysia Berhad, why on earth are they allocating capital to an island in the Indian Ocean?
Because of concentration risks.
Ah.
Yeah, we score their geographic and operational diversification an 8.5 out of 10, specifically because of this structure. Let's compare the armor, right?
Okay.
Heineken Malaysia has 100% concentration risk in the Malaysian market. If the Malaysian economy stumbles, or if local consumer spending dries up.
Or if tax regulations change.
Exactly. Heineken takes the full, unfiltered kinetic impact of that blow.
So think of Carlsberg's corporate structure like a ship with bulkheads.
I like that.
If Heineken takes a hit to the Malaysian economy, their entire hull floods because it's just one big open space.
Right?
But Carlsberg has Singapore and Sri Lanka sealed off in separate, watertight compartments. So a localized shock in Malaysia might make the ship sit a little lower in the water, but it doesn't sink the vessel.
That is the exact mechanical advantage. Singapore historically accounts for around 30% of Carlsberg Malaysia's total group sales.
Which is huge.
It is. It provides exposure to a higher income demographic and, crucially, a different currency.
Right.
And that Sri Lankan associate, Lion Brewery, it is a phenomenal cash cow. In the financial year 2025, that passive 25% equity stake contributed 36.2 million ringgit directly to Carlsberg's bottom line.
Let's frame that 36.2 million. That isn't top-line revenue they have to spend money to generate. Right?
Yeah, not at all.
That is pure bottom-line profit flowing directly onto their income statement just from holding the equity.
Exactly. And the momentum there is accelerating. In the first half of 2026 alone, the share of profit from Lion Brewery increased by 8.2% year-on-year. It hit 17.2 million ringgit. And that growth happened despite a foreign exchange drag where the Sri Lankan rupee actually weakened against the Malaysian ringgit.
So the underlying volume and pricing power in Sri Lanka is so strong it just overpowered the currency penalties.
Exactly. The business itself is just printing money.
Okay, so we have a legally protected domestic duopoly, and we have this ship with bulkheads geographic spread to protect against localized recessions.
Right.
But none of that financial engineering really matters if the consumer doesn't actually want the product.
That's true.
Like at the end of the day, a human being has to walk into a supermarket or sit down at a CAPM and consciously decide to hand over their hard-earned cash for this specific liquid.
And the consumer pull here is formidable. We score their brand equity and pricing power an 8.5 out of 10.
That's solid.
Very. And this isn't just relying on vague marketing terms like, brand loyalty.
Huh.
We have hard empirical data. The industry estimated price elasticity for legitimate tax-paid beer products in this market is 0.94.
Okay, let's translate that elasticity metric, because it's basically the secret engine of their profitability.
It really is.
An elasticity of 0.94 means that if Carlsberg aggressively raises their prices by 1 full %, the actual volume of beer they sell only drops by 0.94%.
Exactly. The drop in physical volume is mathematically smaller than the increase in the price tag.
Meaning every single time they hike the price, their total overall revenue goes up.
Right. It is the textbook definition of inelastic consumer demand.
I mean, most companies are terrified of raising prices because they know their customers will just switch to a cheaper alternative.
Yeah, but Carlsberg knows their customers will just complain about the price and then buy the beer anyway.
Exactly. And that inelasticity provides an incredible shield against inflation.
It does. When global supply chains break down, when the cost of aluminum for canning spikes, when agricultural yields push up the price of malted barley and hops.
Or when the government inevitably hikes excise taxes.
Right. Carlsberg doesn't have to absorb those costs and crush their own margins. They simply pass the costs straight through to the consumer, knowing the volume will essentially hold steady.
And the primary mechanism they use to execute that pricing power is portfolio segmentation.
Yeah, they aren't just relying on the classic green glass bottle of Carlsberg Danish Pilsner anymore.
Right. The management team has meticulously engineered this tiered product hierarchy designed to capture every single socioeconomic bracket, every flavor preference, and every dining occasion.
The architecture of that portfolio is key to understanding their growth. You have the mainstream core, which consists of the classic Carlsberg Danish Pilsner and the Carlsberg Smooth Draft.
Okay.
Those are the sheer volume drivers that keep the factory running at maximum efficiency. But the actual margin expansion, the outsized profits, comes from their premium and beyond beer portfolio.
This is where we see the mechanics of their Accelerate Sale 27 strategy in action.
Yeah, exactly. It's not just a corporate buzzword.
Right. It is a psychological pricing strategy called premiumization. You convince the consumer to trade up.
Right. You have 1664 Blanc, which completely dominates the premium wheat beer category. You have Somersby Cider, which basically created the modern cider market in Malaysia.
Oh, Somersby's huge.
Yeah.
And it now includes a highly successful 0.0 alcohol-free variant for the soda-curious demographic.
Yeah, that's been doing very well. Plus, you have Brooklyn for the craft beer aficionados. You have Connor's Stout Porter, specifically pushing the new extra malt variant to challenge Guinness.
And we really cannot discuss their premium portfolio without analyzing the mechanics of their most massive recent victory.
A Sapporo transition.
A Sapporo transition. Because starting in early 2024, Carlsberg secured the exclusive rights to locally manufacture and distribute Sapporo premium beer across both Malaysia and Singapore.
Which was a massive strategic pivot. They had to deliberately transition away from their long-standing partnership with Asahi to make room for Sapporo.
I mean, I imagine retooling the Sha Lam factory to perfectly replicate a premium Japanese beer recipe is incredibly complex.
Oh, it requires immense technical precision and heavy initial marketing spend to shift consumer habits.
Right.
But the execution was flawless. Within an incredibly short time frame, Sapporo's sales volumes in Malaysia completely surpassed the peak volumes they were previously doing with Asahi.
That's crazy.
They essentially swapped out the engine of their premium Japanese segment mid-flight, and the new engine immediately ran faster, capturing massive market share.
And while they're driving that premium high-margin narrative at the top, they are aggressively defending the floor.
They have to.
Right. When inflation bites hard and consumers feel the economic pinch, they start trading down. They want cheaper alcohol.
But instead of losing that customer to a competitor, Carlsberg catches them in their own safety net with their value power brands.
Skoal, Royal Stout, and Wusu Red.
Wusu Red is particularly fascinating. It is heavily targeted and marketed specifically for food-paired dining occasions in local restaurants.
Integrating the product into everyday cultural habits.
Exactly.
They essentially have a financial net designed to catch you no matter what your budget is or what the macroeconomic weather looks like.
And orchestrating this entire multi-tier machine is a very specific management team.
Right, let's talk about him. Managing Director Stefano Clini is the architect here.
He is. He has over 3 decades of experience in the global, fast-moving consumer goods industry.
Before taking the helm in Malaysia, he engineered a highly successful turnaround for Carlsberg's operations in Vietnam.
So he deeply understands the nuances of Southeast Asian consumer behavior.
Working alongside him is the Chief Financial Officer, Anthony Young Mun Seng.
Right. And he's primarily responsible for the ruthless capital allocation and supply chain agility that keeps the margins intact.
Yeah, let's drill down into Anthony Young's supply chain management because there was a brilliant detail in the sources regarding the recent geopolitical chaos.
Oh, the shipping lanes.
Yeah. You would naturally assume a brewery sitting in Selangor or Malaysia wouldn't care about conflicts in the Middle East. But brewing is a globalized process.
It is. They source specialized packaging materials, specific hops and raw barley from Europe and China.
Right. And when the shipping lanes through the Red Sea and West Asia became compromised, freight costs skyrocketed and the delivery timelines just evaporated.
But Young noted that while the broader value chain was disrupted, Carlsberg seamlessly rerouted their entire supply line away from West Asia.
Wow.
They locked in alternative freight routes and suppliers before the bottlenecks could halt production in Shah Alam.
That isn't just luck. That is high-level, predictive supply chain agility.
Exactly. And that agility allows them to be incredibly tactical with their pricing. Young explicitly mentioned that they have not implemented a broad price hike since September 2025.
Oh, really?
Yeah, they are actively choosing to manage their cost base internally through efficiency rather than blindly hiking prices right now.
Because they know the macroeconomic environment is shaky, and they don't want to risk shocking the consumer and damaging their volume momentum.
Exactly. That disciplined approach translates directly into the financial track record that investors care about. They maintain steady, reliable top-line revenue growth.
But if you're holding this stock, there's only one metric you are really watching.
The dividend policy.
The dividend policy. Carlsberg operates with a massive, aggressive dividend payout ratio, consistently returning over 90% of their earnings to shareholders.
Which brings up a critical accounting quirk that often scares off amateur investors.
Oh, the NTA.
Yeah. If you pull up Carlsberg's balance sheet over a multi-year period, you will see their net tangible assets, their NTA, actually declining over time.
And for almost any other company, a shrinking asset base is a massive red flag.
Huge red flag.
It means the company is cannibalizing itself. But here,
it is completely by design. Carlsberg generates a monumental amount of free cash flow. And because their factories are already built and highly optimized, they require very little ongoing capital expenditure to maintain the business.
right, they don't need to hoard billions of ringgit in a bank account.
Exactly. So they systematically flush almost all of their profits directly back out to the shareholders every single quarter.
So the asset base shrinks on paper, but the cash in the shareholders' pockets grows.
Precisely.
Okay, the strategic table is fully set. We have a legally protected monopoly light. We have inelastic loyal trinkers who happily absorb price hikes. We have a ship with geographic bulkheads covering Malaysia, Singapore, and Sri Lanka.
And we have a management team obsessively focused on premium margins and high dividend payouts.
The ultimate defensive armor.
It really is.
Exactly. So how did that armor actually hold up when it took a direct hit? Let's talk about the quarter that caused Heineken to absolutely crater and see how Carlsberg navigated the exact same economic storm.
This is where the divergence between the two companies becomes incredibly stark. Let's break down the sheer mechanics of the Q2 and first half 2026 earnings report.
Okay, hit me with the numbers.
For the group's first half of 2026, so January through June total, revenue hit 1.22 billion ringgit.
Wow.
That represents a 5.9% increase year-on-year. Profit after tax, the bottom line PT, came in at 181.9 million ringgit, which is a 3.1% increase year-on-year.
So steady inflation-beating growth across the board for the 6-month period.
Right.
But the real stress test isn't the half-year average. It's that dangerous second quarter specifically. What happened in Q2?
For Q2 specifically, the 3 months ending in June, revenue was 514.9 million ringgit, up 5.0%.
Okay.
And PAT was 82.9 million ringgit, up 1.2%.
Okay, if you're sitting there holding Heineken stock right now, listening to those numbers, you might be feeling a severe wave of buyer's remorse.
Oh, definitely.
Let me highlight the absolute contrast here for the listener. In that exact same Q2 2026 period, facing the exact same Malaysian consumer, the exact same tax rates, and the exact same weather, Heineken's revenue collapsed by 19%.
And their net profit plunged by an agonizing 39%.
Heineken crashed. But Carlsberg grew. I mean, it wasn't explosive hypergrowth, but in an environment that literally crushed their direct rival, Carlsberg expanded their top line by 5% and successfully defended their net profit.
It is a profound display of operational resilience.
It really is.
However, when we pull out the scalpel and look under the hood of those consolidated group numbers, the narrative gets much more complex.
Right.
It was not a uniform victory. Malaysia was the absolute hero carrying the weight in the first half of 2026.
The domestic market was the engine room.
Heavily. In Malaysia alone, 1H26 revenue surged 9.2% to 943.6 million ringgit.
That's a big jump.
It is. And operating profit grew a very healthy 6.7% to 199.6 million ringgit.
Do we know what drove that?
Management attributed this largely to a structural calendar advantage. Basically, a longer and highly effective Chinese New Year selling period, which is historically the single most massive catalyst for beer consumption in the region.
Okay, I have to push back hard on this narrative right here.
Go for it.
Because we just spent 10 minutes explaining the brilliant ship with Bulkheads analogy, praising Singapore as this vital geographic hedge designed to protect the overall group.
Right.
But if Malaysia was the hero surging 9%, what was happening in Singapore during this exact same time frame?
Well, the bulkhead held, but the compartment certainly flooded. Singapore is the undisputed weak spot in this earnings report. For the first half of 2026, Singapore revenue actually fell 4.0% down to 277.2 million ringgit.
Okay, that's not great.
No, but the real devastation was in their margins. Singapore's operating profit tanked by a brutal 21.6%, dropping to just 19.5 million ringgit.
Ouch.
And if you isolate just Q2, Singapore's operating profit essentially collapsed, falling by 47.3%.
Cut in half in a single quarter.
Yes.
That isn't a slight miss. That is a systemic failure in that specific market.
What exactly is the trifecta of pain hitting the Singapore operations right now?
It's a very specific compounding trifecta. First, weak domestic consumer sentiment within Singapore itself.
Okay.
The macroeconomic data shows consumers there are feeling the inflationary pinch, and the very first thing they cut back on in bars and restaurants is high-margin premium beer.
Makes sense.
Second, lower export sales out of the Singapore hub to other regional markets, which traditionally pads their volume.
Right.
And third, and this is arguably the most insidious, a major accounting headwind driven by currency translation.
Oh, the strength of the Malaysian ringgit? Exactly. When the Malaysian ringgit aggressively appreciates against the Singapore dollar, as we've seen recently, the fundamental math turns against them.
Right, because the operations in Singapore generate profits in Singapore dollars.
Yes. But when Carlsberg consolidates their financial statements at the end of the quarter, they have to convert those Singapore dollars back into ringgit.
And because the ringgit is stronger, those Singapore dollars buy fewer ringgits.
Exactly. So even if they sell the exact same physical volume of beer in Singapore this year compared to last year, the reported profit on the Malaysian balance sheet looks significantly worse simply because of the exchange rate mechanics.
Wow. So the Malaysian domestic team essentially had to work overtime and carry the entire group to cover for Singapore's multi-layered stumble.
They really did.
But despite the Singapore drag, Carlsberg as a whole managed to protect its overall gross margins. How did they mechanically achieve that against the brutal realities of inflation and the looming tax pressures we know exist in this sector?
This circles directly back to the premiumization strategy we discussed earlier. They defended their margins by aggressively shifting the mix of what they sell.
Oh, right.
When you convince a consumer to buy a bottle of 1664 Blanc or a pint of Sapporo instead of a standard can of Skull, the absolute profit margin on that premium item is exponentially higher.
Because the cost to brew the premium beer isn't that much more, but the retail price you can charge is vastly superior.
Precisely. So even if total group volume softens slightly because of the economy, the mix of the liquid moving out of the factory is much richer. They are mathematically squeezing more profit out of every single drop of water they brew.
And as we know, they take that profit and they immediately give it back to the owners.
Which brings us to the part of the deep dive the income investors have been waiting for.
Yes. Alongside these Q2 results, the board of directors declared a second interim dividend of 21 cents per share.
That brings the total dividend declared just for the first half of 2026 to a very robust 45 cents per share.
Which perfectly tracks with their historical payout ratios. Despite the chaos in Singapore and the collapse of their rival, the cash-generating machine didn't miss a beat. They generated the cash and they distributed the cash.
Exactly.
Okay, let's pull back and summarize the reality of the situation. The underlying business is fundamentally healthy.
Yes.
They survived the Q2 destocking bloodbath that completely took down Heineken. They grew their top-line revenue, they protected their bottom-line profits through premiumization, and they're continuing to pay out massive dividends.
Right.
Yet, because of the algorithmic emotional sympathy sell-off dragging the whole sector down, we are staring at a deeply depressed stock price of 14 ringgit and 46 cent.
It's quite the disconnect.
It is. So the ultimate question for everyone watching, is this the definitive buying opportunity of the year for Night Eyes 08 viewers?
Well, let's run the deep valuation math and find out exactly what this company is worth on paper.
But before we crunch the numbers, I want to take a quick second. If you are sitting there holding either of these stocks, or if you are just fascinated by the sheer mechanics of a duopoly war, let us know where you stand.
Yeah, drop a comment below right now.
Are you team RLSBG, banking on the resilience in the yield? Or are you team H, betting that the worst is over and a massive turnaround is imminent? Your comments genuinely drive the direction of this channel.
They do.
So smash that like button, make sure you subscribe so you don't miss our next sector breakdown, and let's get back to the math.
The math is where the narrative meets reality.
Yes.
We need to conduct a quantitative analysis using the dividend discount model, or DDM, to calculate the intrinsic fair value of Carlsberg stock.
For those who might be new to advanced valuation, let's explain the core concept of a DDM simply. A share of a stock is, fundamentally, just a legal promise to pay you a stream of cash in the future. The dividend discount model is a mathematical formula that takes all those expected future dividend checks, shrinks them down to account for the risks of inflation and market chaos, and tells you exactly how much that giant pile of future cash is worth in today's ringgit.
It strips away the market emotion and just looks at the cash flow.
Exactly. So let's start with the baseline. What have they actually paid out over the last year?
If we look at the trailing 12 months, meaning we add up the dividends declared in Q3 2025, Q4 2025, Q1 2026, and this latest Q2 2026 report.
Okay.
Carlsberg has declared a cumulative total of 113.0 sen, which is 1 ringgit and 13 sen in dividends per share.
Let's do the immediate yield math for the listener. If you log into your brokerage account tomorrow and buy the stock at the crashed Sympathy sell-off price of 14 ringgit and 46 cent,
Right.
and Carlsberg simply maintains that exact 1 ringgit and 13 cent payout over the next year, you are locking in a massive 7.8% dividend yield.
That's huge.
For a legally protected consumer monopoly blue chip stock, a 7.8% yield is incredibly high. You usually only see yields like that in highly leveraged REITs or declining industries, not growing consumer staples.
The yield is highly attractive, yes. But to find the true intrinsic value, we have to project into the future.
Right.
We start by determining our discount rate, the required rate of return that an investor must demand to take on the specific risk of owning Carlsberg. We calculate this using the Capital Asset Pricing Model, or CAPM.
And what does that give us?
Our formula outputs a required return of 7.5%.
Okay, let's break down the actual ingredients of that 7.5% CAPM for the finance nerds listening, because it proves we aren't just pulling numbers out of thin air.
Absolutely. The foundation is the risk-free rate, which we set at 3.9%.
Which reflects the current yield on 10-year Malaysian government securities, right?
Exactly. It represents the baseline return you could get with zero risk of default. Next, we apply a beta of 0.80.
Let's explain beta. If the overall stock market is 1.0, a beta of 0.80 means Carlsberg is theoretically 20% less volatile than the broader market.
Right. If the index drops 10%, Carlsberg should theoretically only drop 8%.
Which makes logical sense.
Yeah.
If a recession hits, people stop buying airline tickets and new cars, but they generally don't stop buying beer.
Right.
It is a highly defensive consumer staple.
Precisely. And the final ingredient is the equity risk premium, which we calculate at 4.5%.
Okay.
This is the extra return investors demand to compensate for the general risk of investing in equities rather than safe government bonds adjusted for the current Malaysian economic climate.
Right.
You combine the risk-free rate, the beta, and the risk premium, and you get our 7.5% discount rate.
Okay, we have the discount rate, we have the historical dividend. Now we run the future scenarios.
Scenario 1 utilizes the standard Gordon growth model. This model assumes the company will grow its dividend at a constant, unchanging rate forever. If we assume a very conservative, perpetual long-term growth rate of just 3.0%, which barely covers historical inflation.
Right.
The mathematical formula outputs an intrinsic fair value of 25 ringgit and 86 sen per share.
25 ringgit and 86 sen, and the stock is currently trading at 14 ringgit and 46 sen.
Yes.
Wow.
But if we run scenario 2, which is a two-stage DDM, the valuation gets even more aggressive.
How so?
In this scenario, we assume they can achieve a slightly higher 5.0% growth rate for the next 5 years.
Okay.
This accounts for the successful execution of the Accelerate Sale 27 premiumization strategy and the massive anticipated tourism volume boost from the government's Visit Malaysia 2026 campaign.
That makes sense.
After those 5 years of 5% growth, we assume they settle back down into that 3.0% terminal growth rate forever. Under this two-stage model, the intrinsic fair value jumps to 28 ringgit and 26 sen per share.
So based on pure cash flow mathematics, we have a fair value range of roughly 25.80 to 28.20.
Correct.
Let's emphasize the sheer scale of the gap here. The stock is currently sitting in the market at 14 ringgit and 46 sen.
Yeah.
That means Carlsberg is trading at a staggering 44% to 48% discount to its intrinsic mathematical value.
It represents a colossal margin of safety for a new investor entering the position.
Okay, here is where my internal alarm bells start ringing at maximum volume.
Oh, yeah.
Yes. Whenever I look at a screen and see a 48% discount on a blue chip, highly profitable duopoly stock with zero structural debt, my value trap alarm just screams.
It's healthy to be skeptical.
The collective intelligence of the stock market is rarely that wrong without a very specific, terrifying reason. What is the market pricing into this stock that this pure cash flow math is completely missing? Why is this stock trapped under 15 ringgit?
That is the most critical question of this entire deep dive. The math assumes a relatively smooth road ahead. The market, however, is staring directly at the potholes.
Right.
It is the reason we kept their financial moat score and forcefully deducted 3 full points for systemic headwinds. There are 3 massive structural risks acting as gravity, pulling the valuation down right now.
Okay, the first one being the government's favorite lever, taxes.
Exactly, excise tax risk. Effective November 1st, 2025, the Malaysian government implemented a brutal 10% hike in the alcohol excise duty.
Wow, 10% at once.
Mechanically, it raised the tax rate to a staggering 1 ringgit and 93 sen per degree of alcohol per liter.
To put that in perspective, Malaysia already operated under one of the top 3 highest tax regimes for beer globally.
Right, competing only with places like Norway and Singapore for the title. This new 10% hike exerts severe compounding pressure on the retail price. It tests the absolute breaking point of consumer affordability.
And here's the most dangerous mechanism in this entire industry. When you push the price of legitimate tax-paid beer too high, you don't just lose sales to people drinking water.
No, you actively feed the second major systemic risk.
The illicit contraband market.
Exactly. High tax rates artificially create a massive structural price gap between a legitimate can of Carlsberg and a smuggled, untaxed can of contraband beer.
It's a huge, persistent leakage problem. The logistics of the smuggling are highly sophisticated. They utilize porous coastlines and parallel supply chains.
Industry estimates suggest that untaxed contraband accounts for a staggering 60% of total beer consumption in the East Malaysian states of Sabah and Sarawak.
Let that sink in.
Yeah.
60%.
Yeah.
More than half the beer physically consumed in those states is smuggled in without paying a cent of that 1 ringgit and 93 sen excise tax.
And it remains roughly 20% in peninsular Malaysia. Every time the government hikes the tax, they simply widen the price advantage for the smugglers, incentivizing more illicit volume.
Right. The legitimate brewers, operating through the Confederation of Malaysian Brewers, are constantly funding enforcement, working with the multi-agency task force, customs officials, and the marine police to intercept shipments.
But it is a massive, highly lucrative parallel market that permanently caps Carlsberg's true volume growth potential.
Okay, so taxes create a crushing price ceiling, and smugglers undercut the floor by offering a cheaper alternative.
Right.
But honestly, neither of those factors explains a sudden, immediate 48% discount.
No, they don't.
Those are chronic, long-term conditions, not acute heart attacks. There has to be a contagion fear here. What is the third risk?
The Heineken contagion. The market is looking at the absolute inventory disaster that just eviscerated Heineken's Q2 revenue. The mechanics of Heineken's crash were terrifying. Their local distributors were completely choked with aging inventory because end consumers stopped buying at their usual pace.
Right. And Heineken had to forcefully cut off their own factory sales, purposely choking their own revenue, just to let the distributors slowly clear the backlog out of the warehouses.
Exactly. And the market is terrified that Carlsberg is hiding the exact same disease.
They're assuming that if Heineken's distributors are choking on unsold inventory, Carlsberg's distributors must be heavily overstocked as well, and the management is just delaying the inevitable factory shutdown.
The entire sector's sentiment was heavily derated by Heineken's plunge. Institutional investors hate uncertainty.
They really do.
They are assuming Carlsberg caught the exact same coal, and they are simply waiting for the other shoe to drop in Q3. They refuse to pay fair value until Carlsberg proves definitively that their distribution pipes are clean.
Well, that fear of destocking forces us to ask the ultimate question. If we put these two business models in the exact same stress test environment, who actually has the better armor?
Let's find out.
It is time for the ultimate showdown. We've looked at Carlsberg in isolation. Let's put these two heavyweights in the ring together for the final financial moat scorecard comparison.
Based on the latest synthesized 2026 data, we have our official verdict.
Okay, what is it?
We assign Carlsberg an 8.0 out of 10 for its overall financial moat. Heineken, following that disastrous structural failure in Q2, has been officially downgraded to a 7.5 out of 10.
Carlsberg takes the definitive lead.
They do.
Let's look at the fundamental contrast, the tail of the tape for the first half of 2026, because the divergence is staggering. Carlsberg grew revenue by 5.9% and grew PAT by 3.1%.
Right.
Heineken, in the exact same economic climate, shrank revenue by 15.7% and saw their PA contract by an agonizing 24.5%. It is literally night and day.
It really is. But the real lesson for investors isn't just what happened. It is why Heineken crashed so violently while Carlsberg held steady.
Right. To understand the why, we have to dive into a crucial financial concept: operating leverage.
Yes. A commercial brewery is a highly capital-intensive business model. You have massive, unavoidable fixed overhead costs.
Right.
You have giant multi-story stainless steel fermentation tanks that require constant massive amounts of electricity for temperature control, whether there is 10,000 liters of beer inside or 10 liters.
Well,
You have highly specialized labor, expensive automated bottling infrastructure, and massive wastewater treatment plants.
so basically like flying a commercial 747 airplane.
Oh, that's a great comparison.
Yeah, it costs almost the exact same amount of money in jet fuel and pilot salaries to fly the plane whether every seat is full or the plane's completely empty.
Right.
You can't just turn off half an airplane to save money. And you can't just turn off half a fermentation tank.
Yeah.
The fixed costs are absolute.
That is the perfect analogy. So when Heineken purposefully choked off their own sales volumes to let their distributors clear that aging inventory, their top-line revenue dropped sharply.
But all of those massive factory fixed costs stayed exactly the same.
Yes. This triggered a mechanical chain reaction we call violent fixed cost deleveraging.
The immutable costs completely crushed the shrinking revenue. The margins collapse inwardly.
Exactly. Because of that deleveraging, Heineken's net profit margin plummeted down to an anemic 11.6% in Q2.
Wow.
In stark contrast, because Carlsberg maintained their physical volume moving through the factory and simultaneously leveraged their premium brands for higher pricing, they successfully defended a highly lucrative 16.1% net margin in Q2.
Carlsberg's ability to convert raw revenue into actual bottom-line profit is simply vastly superior right now.
It is.
And a massive part of that margin strength, that conversion ability, has to do with how physically efficient their factory is compared to the competition. Let's talk about the CapEx cycle, because this is a hidden advantage that most retail investors miss entirely.
Cash flow and physical efficiency are intimately linked. Between 2022 and 2024, Carlsberg undertook a massive 200 million ringgit transformation and upgrade program at their Shah Alam brewery.
200 million, that's huge.
They didn't just tweak things, they modernized the entire nervous system of the facility. They expanded their glass bottling capacity by 40%, their canning lines by 33%, and their liquid filtration capacity by a massive 70%.
That is an immense scale-up,
Yeah.
but it's not just about producing more liquid, it is fundamentally about producing it cheaper.
Absolutely. The crown jewel of that upgrade was the installation of a new centralized cleaning in place, or CIP, plant.
Yeah.
This state-of-the-art infrastructure yields permanent, ongoing utility savings that compound every single day.
What kind of savings?
They achieved a 5% reduction in total water usage, a 3% reduction in heat energy required for boiling, and a 1% reduction in total factory electricity.
In a business where water and energy are your two biggest variable input costs after raw barley, shaving off 5% permanently is a monumental competitive advantage.
It creates a highly optimized, low-cost production baseline that competitors simply cannot easily replicate without spending hundreds of millions of ringgit themselves.
Right.
And crucially, from an investor's perspective, that 200 million ringgit heavy capex cycle is now completely finished.
Meaning the heavy lifting is done. They don't have to spend that money again anytime soon. The cash is free to flow to the shareholders.
Precisely, which unlocks incredible free cash flow metrics. In FY25, Carlsberg achieved a near-perfect operating cash flow to net profit conversion rate of 98.6%.
That's incredible. Almost every single dollar of accounting profit generated on a spreadsheet translated into hard, tangible cash in the bank, completely unencumbered and ready to be paid out as dividends.
It's a beautiful thing to see on a balance sheet.
Okay, we've been heavily praising Carlsberg's mechanics, and rightfully so. But to remain perfectly impartial as analysts, I had to play devil's advocate here.
Go for it.
Does Heineken have any structural advantage here? If someone is looking at that catastrophic 10.5% drop in Heim stock and thinking, this is the ultimate bottom, this is a turnaround play, what is the actual mathematical bull case for buying Heineken right now instead of Carlsberg?
Heineken does possess two distinct advantages that cannot be ignored: a pristine balance sheet and a massive, known future catalyst.
Okay, let's start with the balance sheet.
First, the balance sheet mechanics. Heineken operates with an incredibly rare, completely debt-free structure. Zero outstanding borrowings.
Well, zero debt.
Carlsberg, on the other hand, does carry 25.3 million ringgit in short-term borrowings on their books.
Let's contextualize that, though. Carlsberg also holds 190.4 million ringgit in raw cash, giving them a net cash surplus of 165.1 million ringgit. They could write a check tomorrow, pay off all that debt, and still have over 100 million ringgit left over. They are perfectly solvent.
They are entirely solvent, yes. But Heineken's absolute zero debt status gives them bulletproof financial flexibility in a high interest rate environment.
That makes sense.
It is the exact reason they were able to confidently maintain their 40-cent interim dividend payout despite their Q2 profits collapsing. They didn't have to worry about servicing debt covenants. They just paid the shareholders out of their reserves.
Zero debt is always a phenomenal sleep-at-night factor for a long-term investor. But a clean balance sheet doesn't grow revenue. What is this massive catalyst you mentioned that could actually trigger a turnaround rally for Heineken?
This is the strategic wildcard that the market is waiting for. Heineken has an exciting structural geographic shift scheduled to hit in Q3 2026.
Okay.
Asia Pacific Breweries, Singapore, their sister company, is officially transitioning its operations to an import-based model.
Wait, really?
Yes. And Heineken Malaysia is scheduled to begin exporting locally brewed beer directly to Singapore to meet that massive new demand.
Oh, wow. So Heineken is finally getting their own version of a geographic expansion. They're finally breaking out of the single Malaysian bulkhead.
Exactly. And mathematically, this export shift is going to be incredibly powerful. It will instantly absorb all of Heineken's excess plant capacity sitting idle here in Malaysia.
Which maximizes their manufacturing economies of scale.
And most importantly, it will completely reverse that nasty, violent fixed cost deleveraging we just spent time analyzing. When that new Singapore volume starts flowing through their factory, their margins should experience a rapid, aggressive expansion. It is a massive turnaround trigger waiting in the wings.
So if we pull all of these complex threads together, you have two incredibly distinct, structurally opposed choices in this duopoly right now.
You really do.
On one side, you have Carlsberg, the resilient, geographically hedged, hyper-efficient cash machine. They successfully survived the Q2 destocking crisis that physically broke their rival.
Yes.
They just completed a state-of-the-art 200 million ringgit factory upgrade. They are yielding nearly 8% in dividends, and they are trading at a massive 48% discount to their intrinsic mathematical value simply because the market is terrified of industry-wide ghosts and contraband smugglers.
And on the exact opposite side, you have Heineken.
Right.
The debt-free giant that just took a historic beating, resetting market expectations to absolute zero. But they are sitting on a known upcoming export catalyst to Singapore in Q3 that could instantly reignite their factory engines, expand their margins, and trigger a massive turnaround rally that catches the market completely off guard.
It is a genuinely fascinating standoff between resilience and turnaround potential.
It'll be amazing to watch play out.
And that brings us to the close of today's deep dive.
Yeah.
I give a huge specific thank you to the viewer whose comment inspired this analysis.
Yes, thank you.
It really proves that we read your feedback and we actively respond to the intellectual puzzles you guys want to see broken down on the Night ISO 8 channel. Please keep the challenging requests coming.
It also proves a fundamental law of sector analysis. Evaluating both sides of a duopoly is the only way to truly understand a market's health.
Absolutely.
You cannot accurately analyze Carlsberg's current valuation without understanding the specific mechanics of Heineken's failures. And conversely, you cannot understand Heineken's future turnaround potential without seeing the benchmark of Carlsberg's current resilience. They are inextricably linked.
Exactly. They define each other's boundaries. So I am going to leave you, the listener, with a final strategic question to mull over as you review your own portfolio. We've laid out the financial x-rays, we've shown you the underlying mechanics of the moat, the CAPM math, and the operating leverage traps.
So what's the play?
Are you stepping into the market right now to boldly buy Carlsberg's 7.8% yield, safely locking it in under 15 ringgit, while the rest of the market is panicked by Contagion fears? Or are you waiting patiently in the wings, letting the dust settle on Heineken, trying to time the absolute bottom to catch that massive Q3 Singapore export turnaround play?
Tough call.
Drop your specific investment strategy in the comments below because I genuinely want to read how you guys are weighing these risks. Hit that like button, make sure you subscribe to the channel, and if you haven't watched our original Heineken deep dive yet, go click on that video right now to get the full, unvarnished picture of the wreckage. See you next time.